Hi, everybody. January 28th, the market update desk with Scott Riley, NMLS number 157524. Well, we see a little more calmness in the market than we saw yesterday. We had that big AI announcement from the Chinese startup yesterday that sent the Dow and many of the mega caps, especially the ones that are focused on AI, tumbling yesterday. In fact, NVIDIA ended the day yesterday, I think it was down 14%. They have clawed back and they're up about 1.5% today. So there's still a lot that's going to play out from all that. One of the things that we're seeing is the bond market's weaker, and one of the reasons is the consumer confidence survey from the confidence from the Conference Board has helped us recoup some of the initial losses. Consumers are clearly feeling less confident in January compared to December. Now that lines up and strengthens the comments that we saw from the University of Michigan Consumer Sentiment a couple of weeks ago, that the consumers less excited and confident about the economy currently. FHA reported that they saw 30-day mortgage delinquencies rise to 6% in November of 24, which is up 2.1% from the beginning of 2022. Now, serious delinquencies, those are over 90 days delinquent, have also begun to rise. Within the report, consumers shared the reason for not being able to make mortgage payments. Consumers are saying that they can't make mortgage payments due to being unemployed, and that has risen significantly, that reason. The share reporting this back in Q4 of 20 was 1.8%, which then rose to 7.7% in 23, and most recently rose to 12.1% in Q4 of 24. This is showing us that the labor market really isn't as strong as what the figures being published by BLS and the media and politicians. The real data is showing the opposite of what's trying to be sold out there, basically. Now, additionally, those not being able to pay because of excessive obligations or too much debt has risen from 2.7% in Q4 of 20 to 20.1% in Q4 of 24. That's a pretty dramatic increase in the inability to make payments. And this is some very important stuff to follow as we go forward. Now, home appreciation case Shiller, which is generally considered the gold standard of appreciation data, showed that home prices were up 0.4% in November on a seasonally adjusted basis. The raw figure was down 0.1, but because this is a weaker time of year for housing, it's always seasonally adjusted higher, which makes sense. Year-over-year home prices rose 3.8%, which is an increase from 3.6% in the previous report. So we're still showing very healthy appreciation. The BLS, or Bureau of Labor and Statistics, released their quarterly new tenant rental index. Now this shows how much new rents are rising or falling. In Q4 24, new rents fell 2.4% year over year. Now that's a big change from the plus 1.6% that we got in quarter 3 of 24. Now this is the first negative reading on rents in 15 years, and it's a very good sign for inflation when we look at the CPI and PPI reports and the PCE, which will come out next week. Housing is such a large calculation within these numbers. We're finally starting to see what we've really been talking about for 12 or 14 months now, that rents are coming down and the shelter component is being overstated within these numbers, and that lag is finally starting to catch up. Now, the new tenant rental index is showing signs that the BLS figures are starting to catch up, which we're talking about. This deceleration is definitely going to help us when it comes to the inflation numbers. Apartment lists also released their new rent index this morning, and that showed that new rents fell 0.2% in January and down 0.5 year over year. The year over year figure moved slightly from down 0.6%. But this has been negative since really mid 23. So these are very helpful parts of what we're looking for in getting these inflation numbers down. Now, on a technical side, mortgage bonds closed above their 50-day moving average yesterday, which is a very good sign from a technical standpoint. Bonds are testing that level as support this morning, and it's holding so far today. If bonds can remain above this level, there is about a 27 basis point room for the upside before we reach a really tough customer, which is the 200-day moving average. 10-year bonds have broken through actually a dual floor of support at the 25-day moving average, which was 4.588 in their Fibonacci level. But it's slightly higher today, and it looks like it wants to retest that Fibonacci level of resistance. Now, so long as we can hold where we are, there's room for yields to move lower until reaching, once again, a very tough level of resistance at the 50-day moving average, which is 4.475. Now, so far today, we've got the 10-year bond up 4 basis points at 4.5667, and mortgage-backed securities are down nominally 1 basis point. So we're going to get some pretty flat trading today, because tomorrow we get the Fed decision and the Fed commentary. That's going to be the market mover for tomorrow. Not really the Fed decision as much as the Q&A with Chairman Powell. Then as we go from that, we're going to be looking very strongly at what the PCE data is going to come in on Friday. So that's what's going to move us the rest of the week. But as long as we can stay steady here and close at our levels that we're at right now, that's a very positive day for us. Give us a call, 616-293-2189. We can help you get pre-approved, connected with some of our realtor partners that we trust and that work for you and have significant experience out in the marketplace. If you're buying right now, you want significant experience in your lender and your realtor. Give us a call. We'll help you understand what's going on and why now is a great time to buy. 616-293-2189. Have a great afternoon.